Yeah, yeah. You guys ready? Just bringing up the chat. All right. Hang on. Here we go. All right, good morning. Welcome to Forex.Today, your YouTube community of more than 20,000 foreign exchange traders. We gather here today to watch the ECB. Yep, the press conference is coming up 38 minutes from now. 39, you might say. Well, all right, fine. So anyways, that's what we're going to do. No cigar this morning, I guess. We'll just drink our coffee, right, Pit Pirates? Arr! Yeah, so anyways, g'day, mate. So that's that. That be that. We could talk about the Fed. Dude, you probably have already gone through everything I could possibly say. You probably already know everything. Over 100 people gathered at FX Bootcamp to do the FOMC together, which is awesome, just awesome. So whatever, ask questions or we'll just wait for the ECB. We can look at the dollar pairs, yen pairs, and all that. Okay. But the whole idea is planning forward, looking forward, anticipating the near future, and using technical analysis to confirm or deny your bias, your hypotheses. Technical analysis isn't what just puts you into trades, because that's only past performance. As you know, trading's risky. Past performance does not predict future results. Therefore, trading is not for everybody. I recommend you stay small, you stay humble, focus on the long term, never risk money you cannot afford to lose. Now the sound. Yeah. Was there sound and then it stopped? Why would it do that? Hang on, let me check something. Yeah, it should be working. Huh. I hope you didn't lose too much. I don't know. It was working, then it was not working. I don't know. Gee whiz. What's going on here? What's going on here, huh? Cray. Just, whoa, what a disaster. All right, so anyways, I don't know what I was saying. Oh, yeah, so we got the ECB, great. We can look at euro pairs. We can look at yen pairs, all that kind of stuff. Sure. We can look at oil. Did you see oil? Holy smokes. Holy smokes. It was down like, I don't know what it was. Down 5% and then up 5%. Wow. Yeah. So be careful. Be careful out there. But, the nice thing about that is it's, oil hit its support. So maybe that's over. Oh, my God. Is it Friday yet? No, it's Thursday. So anyways, oil just cray. So, obviously there's some pricing in of recession, but once it hits that support level, then it's a buying opportunity for bulls, right? So anyways, so we could take a look at that. We could look at gold and oil. Basically, we could tread water until the press conference in 34 minutes and 43 seconds. Yeah, 3443. In the description below, there's some links I'd like you to check out. Or let's switch that around. You should probably check these things out if you are trying to do research on how to improve your Forex trading. There's a link to my book, Strategic and Tactical Forex Trading. There's a link to our community, fxbootcamp.com. There's a link to AI sitting on the Google Cloud that does all your macroeconomic analysis for you, called QuantBox. The link is in the description below. There's a link to tradersway.com, an ethical and trustworthy service provider to your emerging foreign exchange trading business. Well, they'd like to earn your loyalty and respect. They earned mine many, many, many years ago, and I recommend them. So all those resources have been made available to you. So let's get on with it. Morning, Lucas. Lucas is probably having lunch. Probably up at 4 o'clock in the morning feeding the chickens. 8 o'clock, time for lunch. Steak and eggs. And black coffee. Potatoes and onions. Okay, so anyways, we're waiting here for our ECB, so I'll move that out of the way. Yeah, I got to wake up early and feed the chooks. No, that's Australian. All right. Yeah, I guess we got to go on my WTI. Check out the macroeconomics training course, Richard. I believe it's the last video. I think it's video 16, hour 16 of the macroeconomics course. Jim says fried bologna in Cuba, they call it pork. And I'm like, wait, this ain't pork. This is fried sandwich meat. Hey, you're lucky to have that. But look at the price action, huh? Look at the PA on this. Holy smokes. Holy smokes. Holy smokes. That is nutso. That big drop like that. Whoa. Okay, take a closer look. Okay. Zoom in a little bit. It's hard to fit the price action in. Okay. Big gap up. Man, fizzle, whizzle, 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 whizzle. Back down. Okay, many of these many of these assets are retesting the logical prices, which I would argue that's the logical role reversal. We also know if you're a bull, you'd have this set long. I'm not necessarily a bull, but there is this idea that the Fed has paused and therefore inflation is back. Now you're like, the Fed paused, why would that create inflation? Well, raising hikes diminishes inflation. So a policy of no longer raising rates means inflation will not likely fall further, is one logic. Therefore, inflation's either flat or rising. Okay? No, Darko, there's two ideas. One, we have inflation, persistent inflation, and two, we go into recession. So gold reflects the inflation, oil reflects the recession. Yeah, okay, great. Great. Thank you for posting the news. Yeah, well, we know some of their inflation is starting to stabilize. The UK is in a much different situation. So, yeah, so 25 basis, 25 bips. Okay, great. So now the press conference is what we're waiting for. Okay. So anyways, this is inflation. Oil down is recession. And typically they're not, they don't typically coexist, but nonetheless, and part of that is because the Fed has removed, or in the process of removing what they did to create inflation. That's right, monetary inflation. Now there's fiscal inflation. And I don't think the government's going to fix their fiscal inflation. They can't even pass the debt limit. I have a plan for everybody, for the U.S. Public. If I were president, I'd be living fat. If it was up to me, I'd paint the White House black. No, if I was president of the United States of America, I would propose, now I don't know if it'd go anywhere, but I would propose we raise taxes for 4 years, for my 4-year term. And over those 4 years, all the money of the tax increase, which would be temporary, it would be locked into law, it would only last 4 years, and all the money from the additional taxation will go to pay down the debt. No government spending, no increase of spending, no nothing, that's it. Okay. Sky Killer says 0% hike in June. Yeah, but here's the thing. This is why I haven't gone into it. I just assume you guys have done all of this already. But maybe not. I mean, but okay. Okay, we can go back to the June Z, right? 0% for a hike, as Sky Killer points out. 6.6% chance of a cut, which is just idiotic, negligent, laughable. You should be fired. Clearly, somebody doesn't know how to negotiate. But anyways, right? 93.4% chance of a pause in June. If this was higher than that, if this was 10 or 20% for another rate hike, I would understand that. This doesn't make any sense. So, whatever, dude. Okay. And now here's something else that doesn't make a lot of sense to me. We go here, 51% that were paused in July, and there's a 50% chance of a cut in July. July! A cut! So yesterday, Powell said, nope, no cuts. The meeting before, he said, nope, no cuts. Not this year. And yet, we're all trading the June meeting, but you should be analyzing and projecting the July meeting. And this doesn't make any sense. So I think what needs to happen for this to be correct is really what you should be focused on. I see experts in the media that are all focused on them being right. So I just pointed all this out. This doesn't make sense. But it makes sense to somebody. So what is it that they're thinking about? And maybe they are correct, and maybe I am wrong. And that's a much more a constructive way of looking at all of this. And I look at this and I say, okay, this is, for this to occur, there's a total collapse of regional banking. This is not a recessionary cut. This is a crisis cut, right? Okay. If we are going to have such a radically different policy than what's been explained to us currently, then it has to be a crisis. And a good crisis, the end of the world type crisis. Okay. Richard says Powell did signal a pause. No, he signaled that they could pause. Okay. So I think that's the only way for that to work, is that we truly go into a banking crisis. Now, banks are well capitalized, but they may not be solvent. And the idea is and I explained this yesterday, so watch yesterday's video where I do a capital stack of what happens to your bond portfolio as a bank manager if the Fed jacks up interest rates 5% 1 year versus 1 or 2% a year. Okay. So anyways, but this is still like something very big is suddenly very broken. So you have to account for that. But recession wouldn't do that. There's nothing, absolutely nothing that suggests this would be correct based on economics. Okay, so let's say NFP falls a little bit. Do you think NFP will be negative by July? Okay, maybe GDP. Will that be negative by July? Will inflation not just disinflationary, but will we have deflation? De-inflation? Right? So negative jobs, negative GDP, deflation, not disinflation. Are we going to be there in 2 months? I don't think so, right? I don't think we'll be in total economic collapse, meaning based on economics. And only in a scenario like that would the Fed change the policy to suddenly cut rates. But I think that is sort of a moonshot projection. That's a Hail Mary projection. And I don't think it's logical. Okay. Okay, so this is crisis. Okay, that's crisis. Crisis. See, Richard, slowing job growth would not force the Fed to cut interest rates when they just said they're not going to cut interest rates. Like an NFP at 250 or 180. I mean, the economy is still adding jobs, right? Like, there's no crisis. Inflation isn't likely to drop below their 2% target. Two quarters of negative GDP? Well, that takes 6 months, right? Like, the only thing that could make this a reality of dropping from 5.0 down to 4.75 in the next 75 days would be a total collapse in the regional banking system. But I would argue that even though there's some negligence by these banks, well, there's 4,000 banks, there's going to be negligence. But the thing is, a systemic problem is sort of like a tide going out, and you find out who's swimming naked. But the issue is the tide went out. Well, it's a lake. Where'd the water go? The Fed just simply raised interest rates way too quickly because you might argue they were late. So they right? But what happened? Well, essentially, the Fed relied on banks buying bonds that pay nearly 0% yield. Is that the bank's fault? The bank has $10 billion in deposits. What does a bank do with the money? They loan it out. But we're in a financial crisis. You couldn't even go look at a house because you might get COVID. All right, great. So what does the bank do if they're not loaning it out and businesses are getting killed by COVID because the government shut everything down? Again, I'm not here to say that's good or bad, but it did happen. So what does the bank do with the money? Well, the only thing left is to buy treasuries. But the Fed pushed treasuries down to zero and left them there, even when the economy was doing good. Deposits would grow, and the bank would buy more treasuries, paying almost nothing. Remember, we were at a zero interest rate policy for years. All right, so now the banks have this fully deployed $10 billion worth of treasuries that pay nearly zero. And then the Fed jacks up interest rates to 5. We went from 0 to 5. Well, every single bond the banks were forced to buy have collapsed in price. So the banks were forced to buy bonds, but now the Fed is selling bonds. So is it really the banker's fault systemically? Yes, it should all be hedged. But now you're hedging something that doesn't pay you any money. So now you're losing money on your portfolio. But you were forced essentially by the government, based on all the rules of banking, to buy all this debt from the government that doesn't pay you any reward, no interest. So now they hold all this low interest stuff. The Fed's jacked up the rates way too fast for a normal sort of roll-off type scenario where you roll off the oldest debt and you buy some new debt. Well, hell's bells, right? So it's kind of the Fed's problem too, right? But I think it'll be a while before anybody says that. And then also just, in my own thought process, Isn't it amazing that the Fed's been stress testing all these banks, but they didn't stress test that? It never occurred to the regulators that they're raising interest rates and the value of all the bank's treasury holdings would be losing money in the real market. But then they're like, oh, yeah, but that'll only impact the banks if there's a run on the bank. But isn't that what a stress test is? I thought that's what a stress test was. What if there was a total collapse in the economy somehow and lending froze or whatever, right? Like, I thought that was the point. I thought that was the test. And they're like, well, no one's going to run on a bank unless there's like, what? A recession? So anyways, kind of interesting. I kind of wonder if there's a Fed official in charge of the banking system that doesn't know how to do a deposit with their mobile phone. And they're like, wait, what? You can add money to your bank account with your phone? You can withdraw money from your bank account with your telephone? Uh-huh. Okay. All right, this goes back a couple of weeks to a conversation we had in our in our swing trading group. And this is just fascinating because we hit this really important target in here. I think this is it. I might have to go further back. No, I think that would have been it. But we'll leave it there. We hit this really important target. Beep. And we had this discussion, should we buy this or should we be bears? And I'm like, well, technically this is still bullish and it's been working really, really, really well. But if the euro dollar starts to head down, then euro kiwi might head down. Okay, maybe. So you'd have to be sort of risk off. But then there was this other discussion. We used a service called QuantBox, artificial intelligence sitting on the Google Cloud doing macroeconomic research for you, pulling from private and governmental databases, analyzing, scoring, and comparing. And it said, you know what? Somewhere in this period, this pair typically goes from bullish to bearish. And so we talked about it like that, especially since this was an exit anyways. You don't see it on this chart, so I'll save that alpha for the swing trading group because we talked about it 2 weeks ago, and that we were still sort of between the exit and the blue line, like this hadn't happened yet. And so our conversation was, well, if you want to be a buyer of the dip, you certainly can, but you should be cognizant of the exit. But this is a potential entry. We don't know. You could do it. But if this doesn't work, you need to walk, because not only is this top a logical exit, I don't want to get into that burn, but you're probably right. If you push the buttons enough, you're like, this isn't real machine learning, artificial intelligence. Right, but it is gathering data, okay, scoring it, and then comparing asset classes to produce, let's say a fundamentally based bias. But is that truly AI? Is it truly thinking? No, but for most people, like the fact that it's comparing and analyzing, for many, it kind of is. But is it true machine learning? No, because programmers have just simply put in the code and said input, output. Is QuantBox actually thinking and going, well, no. Yes. Yeah, it's big data analysis. Is it true AI? No, I get it. But I think AI is in the lexicon, so people kind of get it better when you describe it that way. But when you're like, oh, well, it's big data, people don't know what that is. So the point is to get people to understand, right? In this case, it's gathering and reformatting, scoring, comparing, and then in an organized, clean fashion, displaying the results of that type of analysis, right? Yeah. So anyways, I know it's a bit strong, but my point is that it's not just a numbered stump. It's not just dumping numbers, right? There are plenty of places on the internet where you can just get the numbers. Great. Cool. Okay, cool. Great. Correct. And it's not really predicting. No, and I wouldn't want that actually. So I'm not interested in that. Cool. Anywho. So this breaking point was the most important part of that conversation, I suppose, but as well as the quant box part of it. I think we can do it this way. And then we got to go do the press conference pretty soon. Okay, we want Euro Kiwi, right? Euro. Anchors away, my boy. Okay. This area. This is the rollover that we're talking about. Boop, 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 boop. Okay. So the interesting thing is now that we're in May, we were here when we were talking about it and said, well, be ready for a complete change of direction. We know it's coming in a matter of weeks. It could be tomorrow. It could be in 4 weeks. Arve says, and don't forget the visualization. Yeah, totally. I mean, again, if the humans don't understand it, then who cares if the computer's got the data, right? Okay. But anyway, so we said between May and June, it seems like there's a change in direction. This was still way up here because we did this in April. And then, boom, big crash. And that's what we do at the Swing Trading Group. That's how the swing do. That's how the swing do. So I'm going to invite Christine Lagarde to our meeting today. So let me get that set up. Hang on. Aim small, miss small. How funny. YouTube sucks. So now they're putting an ad in front of it because it's what? Not a... And I'm not going to be able to change that. Come on, YouTube. Would you stop sucking? Yeah, I'm not going to be able to edit that out. think so. Hey, ha ha ha, I tricked it. You sons of biatch. All right. Okay, now can I control the audio? I think I can. Watch this. Oh, it's so good. Oh, it's so good. Nice. All right. So when Chrissy's up, I'll turn the sound back on. Cool. All right, this will work fine. OD asks a great question. Which is better for investment, gold or real estate? Okay, great. Okay, how much income do you earn from gold? How much money does gold pay you every month? Darko says you can click the dismiss. No, not if it's a display capture. No. But anyways. 0. Okay, great. So is that a good investment? So then we can try something else. Okay, you would buy gold because the as an asset, it will go up in value. Is that correct? Yeah. Okay. So you're betting on what's called net asset value. So you buy $1 billion worth of gold, and you are hoping that at the end of the year you'll have 1.2 billion in gold. Is that right? Now, is this a derivative of gold? Is it a gold futures contract, or are you buying physical gold, OD? Do you have a warehouse full? Okay, great. How much will it cost you to hold $1 billion worth of gold in a warehouse with security? And insure it. I imagine you would have insurance as well. Just in case even the warehouse got robbed, you'd still need insurance. Yeah, okay, but it's expensive. Am I right? So maybe at the end of the day, you're back down to 1 billion again. So you invested all of that. You got no profit to show for it. But what is inflation? So with inflation, right, your real return from investing in gold, okay? So you had asset appreciation minus expenses minus inflation, which is negative 5%. So you've lost 5%. In reality, in real terms. It's the same thing. Byrne says, I think it costs 1%. Yeah. There's a standard model for that, for sure. Yeah, you don't have to build your own facility. No. Right? And in fact, these banks, if you use a bank to store it, there's still a percentage, but then they give you an SKR, a safekeeping record, which is now a piece of paper that says you have $1 billion in gold. And now what you can do is you can leverage that asset as collateral to put something else into trade. And you try to make money off of that. But meanwhile, is it a good a good hedge against inflation? I'd argue there's probably better ways of doing it. Okay. All right. What about real estate? Well, no. Now, a house, no. That's different. When you say real estate, if you got physical gold, then the better way of, you wouldn't buy houses. That's retail. You'd buy an apartment building. So now the building the building is an asset. Okay. And this building, its value goes up and down over time. Again, okay, net asset value. You buy it for $1 billion. Time goes by, and now it's worth 1.2 billion. Okay? But you also have rent minus expenses, which is your NOI, your net operating income, then your debt service. After that, you have your income. Profit you put in your pocket. Where gold, you lose your income because you have to pay for the storage. In this case, it's paying you some profit in your pocket today, and over time, the asset should appreciate in value. And your renters are paying down your debt, so eventually you may not have any debt service. No, you'll never actually do that, but you can think of it that way: as the renters keep paying the bank, the renters keep paying the expenses, whatever's left over is in your pocket. And the more you draw down your debt service through amortization, the more profit you have in your pocket at the end of the day. All right, I got to get going here. Did that answer your question?
Good afternoon and welcome to the ECB press conference. I'm joined here on stage by President Lagarde and by Vice President de Guindos. And my name is Wolfgang Preußel. As always, this is a hybrid press conference. So for the online participants, I would ask them to turn.
I always laugh. I think these guys really know how to party.
To ask questions. And with that, I turn over to President Lagarde. Please.
Thank you very much, and good afternoon. The Vice President and I welcome you to our press conference. The inflation outlook continues to be too high and for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports.
Is there an echo, by the way? I wasn't sure.
Inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, our past rate increases are being transmitted forcefully to euro area financing and monetary conditions, with the lags and strength of transmission to the real economy remain uncertain. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restrictions. In particular, our policy rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The key ECB interest rates remain our primary tool for setting the monetary policy stance. In parallel, we will keep reducing the Eurosystem's asset purchase program portfolio at a measured and predictable pace. In line with these principles, the Governing Council expects to discontinue the reinvestments under the APP as of July 2023. The decisions taken today are set out in a press release that is available on our website. And I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the euro area economy grew by 0.1% in the first quarter of 2023, according to Eurostat preliminary flash estimate. Lower energy prices, the easing of supply bottlenecks, and fiscal policy support for firms and households have contributed to the resilience of the economy. At the same time, private domestic demand, especially consumption, is likely to have remained weak. Business and consumer confidence have recovered steadily in recent months, but remain weaker than before Russia's unjustified war against Ukraine and its people. We see a divergence across sectors of the economy. The manufacturing sector is working through a backlog of orders, but its prospects are worsening. The services sector is growing more strongly, especially owing to the reopening of the economy. Household incomes are benefiting from the strength of the labour market, with the unemployment rate falling to a new historical low of 6.5% in March. Employment has continued to grow, and total hours worked exceed pre-pandemic levels. At the same time, the average number of hours worked remains somewhat below its pre-pandemic level, and its recovery has stalled since mid-2022. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. Fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can also help reduce price pressures in the medium term. In this regard, we welcome the publication of the European Commission's legislative proposals for the reform of the EU's economic governance framework, which should be concluded soon. According to Eurostat's flash estimate, inflation was at 7% in April, after having dropped from 8.5% in February down to 6.9% in March.
Euro week.
While base effects led to some increase in energy price inflation from minus 0.9% in March to plus 2.5% in April, the rate stands far below those recorded after the start of Russia's war against Ukraine. Food price inflation remains elevated, however, standing at 13.6% in April after 15.5% in March. Price pressures remain strong.
You're so funny.
Inflation, excluding energy and food,
but
was 5.6% in April,
stand on the floor
edged down slightly
of a conference
March
in Vegas
to return to its February level.
with a bullhorn telling people to buy gold when it was $625.
In April. Energy industrial goods inflation fell to 6.2% in April, from 6.6% in March, when it declined for the first time in several months. But services inflation increased to 5.2% in April from 5.1% in March. Inflation is still being pushed up by the gradual pass-through of past energy cost increases and supply bottlenecks. In services especially, it is still being pushed higher also by pent-up demand from the reopening of the economy and by rising wages. The information available up to March suggests that indicators of underlying inflation remain high. Wage pressures have strengthened further as employees, in the context of a robust labour market, recoup some of the purchasing power they have lost.
Now you should be fine, Sky Killer.
Inflation.
You've hedged, right?
Moreover, in some sectors,
You just have to sell euro dollar.
firms
You're
have
fine.
been able to increase their profit margins on the back of mismatches between supply and demand and the uncertainty created by high and volatile inflation.
Okay. Monthly
Although
M3.
most measures
Monthly
of longer-term
M3.
inflation expectations currently stand at around 2%, some indicators have edged up and warrant continued monitoring. Let us now look at our risk assessment.
Sounds like church, huh?
Renewed financial market tensions, if persistent,
Let us
would
pray.
pose a downside
Okay.
risk to the outlook for growth, as they could tighten broader credit conditions more strongly than expected and dampen confidence.
Yeah.
Russia's war against Ukraine also continues to be a significant downside risk to the economy. However, the recent reversal of past adverse supply shocks, if sustained, could spur confidence and support higher growth than currently expected. The continued resilience of the labour market, by bolstering household confidence and spending, could also lead to higher growth than anticipated. There are still significant upside risks to the inflation outlook. These include existing pipeline pressures that could send retail prices higher than expected in the near term. Moreover, Russia's war against Ukraine could again push up the costs of energy and food. A lasting rise in inflation expectations above our target or higher than anticipated increases in
Vic
wages
said
or
19.
profit margins could also drive inflation higher, including over the medium term.
Oops.
Recent negotiated wage agreements have added to the upside
Where did
risks
it
to
go?
inflation,
There we go.
especially if profit
Look at
margins
that, huh?
remain high. The downside risks
I just did training on this.
renewed financial
Holy
market
smokes,
tensions,
it's so
which could
good.
bring inflation down faster than projected. Weaker demand, due for example to a more marked slowing of bank lending or a stronger transmission of monetary policy, would also lead to lower price pressures than currently anticipated, especially over the medium term.
That's right, Maida.
So let's look at the financial and monetary conditions.
My war is on poverty.
The euro area banking sector
That'd
has
be the other
proved
thing I'd do as
resilient
president.
in the
Do a
face
war
of
on
the financial
poverty.
market tensions that arose ahead of our last meeting. Our policy rate increases are being transmitted strongly to risk-free interest rates and to the financing conditions for firms, households and banks. For firms and households, loan growth has weakened.
I like how she says it's
owing to
Russia's
higher
war.
borrowing rates, tighter credit supply conditions and lower demand. Our latest bank lending survey reported a tightening of overall credit standards, which was stronger than banks had expected in the previous round and suggests that lending may weaken further. Weak lending has meant that money growth has also continued to decline. Summing up, the inflation outlook continues to be too high for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, our past rate increases
No, that's
are
not
being
what I said,
transmitted
Meta.
forcefully to euro area financing and monetary conditions, while the lag and strength of transmission to the real economy remain uncertain. Our future decisions will ensure that the policy rates
I like it when people have
will
money.
be
The only
brought
way to have
levels
money is
sufficiently
productivity.
restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be
I want
kept
people
at
to be
those
productive,
levels
and if they're
for as long
productive,
as necessary.
they get a share of the wealth. And
We will continue to follow
so
a
my war is on
data-dependent
poverty.
approach to determining the appropriate level and duration of
I want
restriction.
everybody to be rich.
In particular, our policy rate decisions will continue to be based
There's
on
the difference
our assessment
between poor and
of the
poverty.
inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. In any case, we
No, but
stand
Sky
ready to
Killer, if
adjust
everybody is
all of our
productive,
instruments within our mandate
there'll still be
to ensure that
income
inflation
inequality.
returns to our medium-term target,
Some people will be
and to
richer than
preserve
others,
the
but
smooth functioning of monetary
look,
policy
if
transmission.
you want to work all
We're now ready
day
to
and then
take your
Uber all
questions.
night,
Thank you,
and make
President
money,
Lagarde. And the first question goes to Annette Weisbach
then
from
awesome.
CNBC. Annette, please.
now Maida says learning English. No,
Very much,
I'm making a
President Lagarde.
very, very
First
minor
question-
distinction.
My first question would be on the rationale behind the
Between
reduced
poor and
pace
poverty,
in the
but,
interest rate hike
yeah.
of 25 basis points. So why did you come up with that? And my
So
second
I
question
want people
goes
to be
to
entrepreneurial
the US regional
and take care of
lender
themselves
banking crisis,
and be
which is
productive,
over
contribute
yet.
to
So,
society,
how
and make a lot of money.
concerned are you about potential
Now,
spillover
maybe
effects
you're
to
not a
the
millionaire,
euro
but you're making a lot more money than being on welfare.
Thank you for your question. I will take
So
the first,
my
and,
my
maybe I
war
will
is
ask
on
my
poverty,
colleague
and
friend,
poverty
Vice
is
President
from
Luis de Guindos,
being
to address
non-productive.
The second one. So let me
If you're
tell you
on
a little
welfare
bit about
or in
the mood
jail,
in
you're
in
not
the
being
room of the
productive.
Governing Council. I would characterize the mood as determined.
If you've got a drug problem, you're not being
are
productive.
determined to fight inflation, tame inflation, and return it to 2% medium term. And we all concluded, as
I
you
want
have seen,
people to
that
be
the inflation
passionate,
outlook is too
inquisitive,
high and has been so for too
hardworking,
long.
dependable,
I would say then that the
productive,
mood was very focused,
visionary.
and yet it is an
That's what I
in-between
want.
projection
That's what I
Governing
want.
Council
Everyone to
meeting.
be that way. I
But
want
we were extremely
everyone
attentive to all data that
to
was available
make
to
the
us.
world a
And
better
obviously,
place. But this
one
idea of like,
case
give
in
me
point
something
is
for
the
free,
bank
screw
lending
you.
survey that you
Now, some
all,
people need help.
received or
That's
saw,
fine.
on
That's fine.
Tuesday when it was
So I don't mean to
published,
take it
and
too
which
far. I'm
contains
just being
a lot of intelligent and
larger in
information
life so you
about
understand the
the
point,
intention
but
and the comparison between
if you want to be
the lending
productive, I want to help you be
practices and
productive.
standards with what
That's
was
my
expected
point.
by the banks, and I'm happy to come back to that later. But it explains, obviously, the decision that we made for the,
In Brazil,
we were method dependent. In
if
many
you're on
ways,
welfare,
just as
you
we
get
are
no
data
money
dependent, because
if
we
your
have
kids are not
articulated
going to school.
the reaction function.
You get no money
of
if your
monetary
kids are not
policy decisions
immunized.
With the three key elements of
You're like,
the
"Ooh,
inflation
that's
outlook
interesting."
informed by the financial and economic data, the underlying inflation, and the strength of monetary policy transmission. So we checked all the data that we had against these three criteria. And as is always the case at the Governing Council meeting, there was a variety of views expressed. And I think that it's fair to say that everybody agreed that increasing rate was necessary. That second, we are not pausing. That's very clear. Third, we know that we
that
have
should be good
more
for the
ground
euro.
to cover on the basis
We are not
of
pausing yet. Watch
the
it come
baseline
back
that we
up.
had, which is still guiding us until we have our next projection exercise, and on the basis of the data that we have received.
Okay,
in the
we're
course
not
of
pausing.
the last few days, and that we brought
Boom.
together during
Euro
the
should get
meeting.
strong.
So, I think the ultimate balancing act, which received almost unanimous support, and that is reflected in the monetary policy statement in front of you, was really predicated on the methods, the data we received, the understanding that where we are is totally consistent with the baseline that we had for the outlook last time around. Remember, at the last March meeting, that's what I said. And second, that underlying inflation is still high. And third, informed by the bank lending survey and the data that we have concerning interest rates, which is a little bit outdated because it goes back to February, the transmission of our monetary policy is working, at least to the financing leg. And we're not yet certain about the next leg, which is transmission from banks to the real economy. So it's on the basis of all that that we made our decision. Now that we have, increased rates significantly and sometimes by very large increments, I hope establishing absolute credibility on our determination. It was sensible in view of what I have told you to return to a more standard increment with the understanding that based on the information we have today, we have more ground to cover and we are not pausing. That's extremely clear.
Good afternoon. Turning to your second question, I think that we should start by a consideration. If you look at the characteristics of the US banks that are running into difficulties, I think that there are some common features. The first one is that they are medium-sized, regional. They share a very concrete and very idiosyncratic business model, and they are quite open to interest rate risks. They are vulnerable to an increase in yields. And I think that this model, this situation is not extrapolatable to the European banking industry. Well, I will not repeat what we have said many times. European banks are resilient. The level of capital, the level of liquidity, the quality of the liquid assets. But I think that simultaneously we have to remember that an increase in interest rates, in yields, is positive for the European banks because the increase in margins outweighs the potential losses that this increase in yields could cause in fixed income portfolios. But I think that it's quite clear that there is no space for complacency. One of the things that we have been all of us surprised is about how rapidly a bank run can take place and how rapidly a bank can be emptied. And I think that this is the combination of new factors. The first one is digital banking, and the second one is social networks. And the combination of both have given rise to a new situation. And I think that supervisors and regulators, we have to bear in mind that new framework, because we believe that this is going to be key in the near future.
Thank you, President, Vice President. The next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you, Francesco Canepa, Reuters. So my first question is about whether anyone at the meeting insisted on a larger rate hike or on a clearer commitment to more hikes. You just hinted at that by talking about ground to cover, but it wasn't quite as explicit as it was back in the winter when you were talking about steady pace and several rate hikes. Second question is about something you just said, which is, again, that you had more ground to cover. Would you say that we are still in the middle of the journey or towards the end, in the home stretch? Thank you.
Were they going to do 50 or what?
The Emerson quote. It's not so much the destination that matters, but the journey. And we are on a journey. Okay? And
Emerson's a Harvard man.
And under present circumstances and based on what we have, which is the baseline of March, we know that we have more ground to cover. Okay? And there is a clear reference to that if you look carefully, and I know you have because you do that very well. But in the second paragraph of the monetary policy statement, we explicitly refer to that by saying that our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target and will be kept at those levels for as long as necessary. We have covered a lot of ground in the last 9 months, right? Moving from minus 50 basis points to plus 300 basis points. We are continuing this hiking process. As I said, this is a journey. We have not arrived yet. As to, the exact amount of, by how much do we increase rates? As I said in my introduction, in the response to the first questions, there was a variety of views. Some governors suggested that maybe 50 was appropriate. Others also believed that 25 was appropriate. I didn't hear anybody suggest that 0 would be appropriate. So that confirms to you that this is a hiking journey that we are on.
Yes, he is a Harvard
and
man.
it will continue to be so. But at the end of the deliberations, and having had a chance to confront our views and to answer the questions and to really sort of put everything in perspective, there was a general, very strong consensus behind the decision that you have in front of you.
Thank you, Madame Lagarde. And the next question is for Jana Rando of Bloomberg News.
Thank you.
Morning.
Good
afternoon.
Well, good afternoon. I would like to invite you to elaborate a little bit more on your definition of sufficiently restrictive. The IMF had a view the other day, seeing the terminal rate at 3.75%. A lot of economists do that as well. Would that be something, given the inflation outlook we have at the moment, that would be in the ballpark of sufficiently restrictive? The other question I have is that at the last meeting, you had a little bit of a debate about over-tightening and having to reverse course. And I'm wondering whether that discussion continued this time, and whether you would actually be worried that such a scenario might be interpreted as a policy mistake. Thank you.
Well, thank you very much. I don't have a magic number of what constitutes.
You see how as soon as she said it, it's right back.
Sufficiently restrictive, end of quote. I think that the honest answer is we will know what that is.
We are not going to pause, is what she said.
We
Boom,
are
just like
in
that.
the process of moving in that direction. I think what's important is to understand, what it means to have restrictive rates and to be in restrictive territory. And I think the best example is to see whether the rate decisions that we make, the rate increases that we decide, are actually having an impact on the economic actors. And when we look at the bank lending survey in particular, or when we look at the interest rates and the pace at which it has increased in the last few months, it is obviously the fact that interest rate decisions that we made and the interest rates level where we are having an effect. Is it a sufficient effect yet? We don't know, because we are not seeing the transmission at this point in time into this, what I call the second leg of the economy, which is the real activity, which then has an impact on prices and then reduces inflation. So full cycle we're not seeing yet. We're seeing inflation coming down, don't get me wrong, because headline is coming down as a result of energy prices having coming down significantly, as a result of the easing of bottlenecks. But we're not yet seeing the complete impact that we desire in order to arrive at the 2% medium term that constitutes our target. We are very attentive. We look at that. As you know, it's one of the three components that we look at, the inflation outlook. But it is restrictive, no question about it. Is it sufficiently restrictive? Not yet.
Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you. Hello, President Lagarde. I have two questions for you. The first one is on the decision to accelerate the pace of shrinking the bond portfolio at the ECB. Does that mean, now that you're stopping all reinvestments in the APP, does that mean that you plan to reduce the APP to zero eventually? And the second question that I have is, was this decision part of a compromise deal to convince those arguing for a 50 basis point move to accept a 25 basis point move in return for accelerating the pace of shrinking your balance sheet? Thank you.
Well, thank you very much, Martin, for this sort of double question on the same issue of the APP. Well, I would say, number one, we made the decision, but the decision specifically says we expect. So we expect to let the APP run off as time goes by. And in answer to your question about do we go to zero, if we do, then it's going to take the next 15 years. So I don't think I'll be around for that. I know I won't, and I'm not sure that you will be around. But the ultimate perspective is that one as we consider things today. We've decided to expect the effectiveness of that decision as of July, saving a little bit of optionality.
Notice that people are. It was 6% that were betting stupidly.
I've seen that
now it's only 3% of the market's an idiot.
That has been effective
so they're
since
fixing
March.
it.
Has actually run very smoothly and has been well absorbed by markets. So we don't see any point in not accelerating the move.
But this 7.5 went into here. That's, to me, that's quite amazing.
Lower the amount of excess liquidity, complements our policy rate increases, reduce the side effect of a large balance sheet. All of that completely justifies the fact that the APP is let to run off gradually over the course of time, which will be an average 25 billion per month, not reinvested, roughly. But as I said, to run the whole APP program to zero, it will take 12 to 15 years, given the maturities of what we have. I would just reserve one thing, because we discussed it during the Governing Council, and it's not reflected in.
Look at that, 82% chance there's a rate cut coming.
Tilting approach
by
to our investment
the
policy
third quarter
of the APP, and in particular for the corporate bonds, which are the prime targets of that tilting, in order to privilege those corporates that have a good environmental footprint, that have a transition plan, and that disclose all the appropriate information about their plans. Now, of course, if we go to full runoff, that tilting process is not going to be applicable, because there will be nothing to tilt it off. There will be no basis for that. So I think the jury is out as to how we can continue to deliver on our Paris Agreement compliant reinvestment program without the reinvestment phase, and how do we address that, which is something that we agreed we would take into account and consider to see how we respond to that. Was it a deal? No. No. I think there was a general view.
I mean, it's crazy. 100%, 99.95% chance of the Fed cuts interest rates by the end of the year.
Some might have preferred,
but the Fed has told us they're not going to cut interest rates by the end of the year.
The June meeting to announce it, given that it's effective as of the 1st of July. But, with the principle of predictability that we had agreed in the first place, we thought it was just better off to just announce it with reserving a little optionality on the side.
Thank you, President Lagarde. And the next question goes to Aude Kersulek of BFM TV, French television.
Good afternoon, Mrs. Lagarde. About the last banking lending survey, so is there a target for bank lending or limits?
Yes, but if they cut interest rates, they destroy the whole point
in relation to
of what they're trying to do.
On the Credit Suisse case, that you really need to measure what comes out of this financial event. So what are the indicators that you're looking at? Would you say that there is a banking crisis? What's your view of what's happening there in the banking system? Thank you.
Yeah, on the, we know of one and only one target, and this is our medium-term target, 2%. That's what is riveting our attention. But of course, the bank lending survey that we receive on a quarterly basis informs us about the tightening of credit to the economy, and it also informs us about what the banks assess will be or will not be the tightening. And it's quite a sophisticated survey which is really for information, intelligence, anticipation of the credit tightening now and the credit tightening going forward. It's also illustrative of the demand, and that's an interesting point, because in the BLS, the demand from corporates is really, really down. So that's, learning that we take, which indicates that our interest rate policies is beginning to have an impact, because when asked, the corporates say, and we had the corporate survey that was conducted, they say it's the interest rates. It's not that we don't want to invest, but the interest rates are pretty high, and that leads me to the restrictive territory or not. Yes, we are in restrictive territory, because if that is the response of corporates, then it shows that this works. On Credit Suisse, I think I'll say a few words, and then I'll ask my colleague, Mr. de Guindos, to also address that. But number one, it was addressed very swiftly. The Swiss authorities maybe did not have many choices, and it was very specific and probably a long-lasting issue that was lingering and had been lingering for a long time. So I certainly would not draw the conclusion that the merger between UBS and Credit Suisse to be decided is an indication that there is a financial crisis. Far from it. But we are learning. I think that we also learned the value of having rules, and the ability we had to come out very quickly on the pecking order of creditors actually mattered a lot. And I think that we can also take a bit of learning from that. When creditors, investors know exactly who is going to bear the brunt of outstanding liabilities and a situation of insolvency, it just helps. And we did that. I'm glad we did.
Well, just to add that on the question about the indicators that we consider, that we look at, well, we have a range of indicators. For instance, equity prices, bank bond spreads, the evolution of deposits, and we have not seen, the kind of situations that happened in other jurisdictions. So we had, let's say, a sort of increase of tensions after the events in the US with Silicon Valley and with Credit Suisse, and afterwards, the situation has been quite calm. So we are continuously looking at those indicators. But, clearly, now, the conclusion is that the European banking industry has been clearly outperforming the American one.
Well, Richard Xu says we are not going to pause.
Included in this kind of indicators and, the potential stress in financial markets.
That's what created this big up.
President. And turning to our online participants now, I would like to give the floor to Francesco Nilfole of Milano Finanza. Francesco, please.
Francesco!
Thank you. Good afternoon.
You have to watch Elf to understand that joke.
Can you explain a little bit more how you reconcile your data dependency with the pledge?
What?
With the pledge?
Excuse us. Can you repeat, because we missed a few questions.
Okay.
Can I explain what?
Can you explain how you reconcile your data dependency with the pledge of doing more in the future? It can be a little bit contradictory, like a forward guidance without a forward guidance. Maybe you can explain it a little bit.
What a jerk question.
Secondly, on core inflation. No doubt it is important to monitor core inflation.
It's a loaded question.
But the ECB's target, as you have said just now, is headline inflation at 2% in the medium term. So how do you explain such a great emphasis on core inflation, also considering that core inflation has not been a good leading indicator for headline inflation in the past? Thank you.
Thank you very much. Data dependency is not forward guidance. And I'll try to explain that for you for a second. I'm not giving you the forward guidance that, come what may, or subject to, or until such time, we will do this or that. That for me would be forward guidance, okay? And we had it in the past, and it was very appropriate to have forward guidance as we were at the lower bound, and that was a tool that was very useful. What I'm telling you now is, given our baseline, the findings that we have, the data that we can analyze today, our judgment in the room is that we are not pausing. That applies to today. And based on what we see, we determine that we have more ground to cover. I'm not saying that in the abstract. I'm saying that with reference to the baseline of March, to what we are seeing in development. And I'm here saying we believe that we have more ground to cover. It is not state dependent. It is not time dependent. It is a judgment that we make today. So I hope I've been clear to try to explain to you how we can actually say that very firmly without giving forward guidance and being data dependent. Comes the June meeting, comes the July meeting, comes the September meeting, and so on and so forth, we will look at the data and we will use the 3 criteria of our reaction function for monetary policy purposes, and we will make our decision on a meeting-by-meeting basis. So, you've also asked me another question about core. We had long discussions about core, and we actually had many more discussions on underlying inflation, because core is interesting. Core is easy to communicate. You take headline, the whole basket of everything that's in the index, you take out food, you take out anything having to do with energy, and you have core. But we want to go a little bit deeper into the index and the evolution that we see. And we have multiple measurements that you are familiar with. The TRIM, the PCCI excluding energy, and so on and so forth. We look at all of those. And we try to understand from the evolution that we see, what is the likelihood of inflation evolution. So, I'm not maybe addressing you core versus headline, but simply I'm saying that headline is the objective that we have, it's the target that we have, that we've agreed in our strategy review. It happens to be what matters to people. People see all prices increasing, and we're working for the people of Europe, okay? Core, easy to communicate, but maybe not as informative as we want it to be, so that leads us to dissect in far more details inflation. Thank you.
Thank you, President Lagarde. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Madame Lagarde, I'm sure many people will be interested to know whether the worst of inflation is over for food. Do you have that impression?
Thank you for that question, because it is food prices that is hurting most, particularly the most vulnerable people. And we know that because in the basket of consumption, the most vulnerable spend a lot more on food than those who are well off. So we pay special attention, of course, to food and the increase in prices. We have seen it go down, right? If you compare March and April numbers, so it is going down. But we have to be extremely attentive, because there are multiple factors that apply to food prices, that apply to processed food prices. I think we have also flagged the fact that profit last year, in particular in 2022, have contributed to inflation. This year, 23, what we have seen of 23, we see more wage increases contributing to inflation. We would hope that through a good social contract, these drivers of inflation do not activate each other in what I have called in other places a tit for tat. I want more wages, I'm not going to give up on profits, and you are then at risk of something that is much more difficult and would lead us to have to take more active measures in monetary policy. So I wish I could tell you, of course it will continue to go down, but I'm observing that it has gone down. There are other factors that will come into play. Clearly climate change is something that will have an impact, probably on a sectoral basis, probably in relation to certain food items. What happens in Ukraine is also going to bring another uncertainty in the background of cereal price in particular. But commodity prices have gone down. That is a fact. So hopefully it will channel to the ultimate consumer.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madame Lagarde. Can the ECB continue hiking?
Oh yeah,
the Fed
I forgot to
stocks?
check on that.
Is
Thank you for the reminder.
a
Oh, the
baseline
market just
scenario you're
opened.
working on? And second question, do you have any estimates on how much tightening is the QT and the TLTRO maturity adding to the monetary policy stance? Can you perhaps phrase it in hiking or basis points of hikes? Thank you.
I've heard the fiscal dependency, I've heard the finance dependency, I had not heard the Fed dependency. So the ECB is an independent central bank, looks at what others do around the world, from New Zealand, which has been an interesting innovator in the field of monetary policy, all the way to the Fed and others. And it's obvious that the US economy, in whichever way it evolves, has spillover effects around the world, given its size, the depth of its financial markets. But we have a target, we have a journey. We know as of today that we have more ground to cover, and whatever the decision of the Fed is in the next few weeks, months, we are going to be riveted to our objective, and we'll of course take into account variables. The currency, for instance, has an impact. Any spillovers will be taken into account.
I have Truist, TFC.
Dependent in that respect. As to the actual tightening impact that
I also have Credit Suisse, but I don't want to talk about
runoff has, I don't want to commit a number, but it does not have a massive impact, suffice to say. But we can give you, separately the exact amount that has been calculated, but it's not material.
Thank you. And the next question goes to Anna Karismo of the Finnish television Yle.
Hello, and thank you for the opportunity, and nice to see you again. We met in Lapland.
Well, Jim, I might bail on it because I don't like the idea that it could just drop 50% in one day.
There are many households in Finland, Lithuania, Spain that struggle with the much higher
right on,
interest
Darko.
rates
Thank
and
you.
have had to cut down on their spending. So how do you take them into account when hiking the interest rates? And then a second one, what should they prepare themselves for? What can you say to them about the future? When can we see the policy rates going down?
Dude, these Europeans are all scared, huh?
Euribor.
Tell us about the future. Tell us about the future.
Nice to see you again in warmer
Gee
circumstances.
whiz.
So, of course, we are aware of these households.
Oh, you got into that, huh?
Loans with floating
I tried.
rates, variable rates, whatever you call it.
It was down, 99%? I tried to get it.
From Finland to Portugal, from some of the Baltic countries to Spain, it is the case that some families are.
But anyways,
are
I want to.
the reimbursements.
I might want to just take it out because I'm building a low beta, and that's definitely a high.
Increases that we had to decide.
Currently a high beta.
This is unfortunately not something that we can, alleviate or attenuate, because our task is price stability. Our task is to reduce inflation, and the tools of choice that works in that respect is the interest rates, and we have to use that interest rates. Some countries are taking particular steps and measures, and some financial institutions are also looking at offering moratorium or delay. And I think that the best we can do is to really tame inflation in a timely manner, meaning as fast as we can, in order to then facilitate a return to different interest rates that would not be as high in the future. And I'm not here making any commitment to cut at any point in time. Thank you very much.
Not going to cut any in time.
Thank you, President Lagarde.
And
the next question goes to Shogo Akagawa of Nikkei, Japanese Newswire, here in the middle.
Thank you. You will travel next week to Japan for G7 meeting. What kind of topics do you want to bring at this upcoming meeting from a European point of view? Thank you.
Thank you for giving us that angle from the East. I would hope that together with my European colleagues, we can learn from colleagues, particularly Japan, which has just now
my building
moving
stocks
into a new direction with a new governor. So anything that will be the Japanese monetary policy going forward, and any understanding that we have of their strategy review,
25.94%.
And I would be very happy to share with him the learnings from our strategy review, which I had started when I took the job. I would also hope that we can
is that right, Jim? That's weird.
To colleagues from Canada, Japan, and the United States that the Europeans together are going to continue to demonstrate resilience.
So I bought home builders for less than their book value.
In that respect, something that we say in the statement here will resonate, which is to agree on the fiscal governance in short order, so that in addition to having a monetary policy that is common to 20 countries, we also have a fiscal framework which gives governance to the 27 member states, and that fiscal policies that are determined by member states are also focused on value for money, for lack of a better word.
Well, yeah, so,
in other words,
Bernd, if you're
putting in place the right reforms,
in QT, the central bank is selling. It has nothing to do with seasonality. QE, the central bank is buying, has nothing to do with seasonality. Those are outliers, if you will. So yeah, if you took them out, yeah.
Social contract, which is often associated with Europe. Thank you.
Thank you, Madam.
But the thing is, if you keep taking things out to get the curve you want, you won't have reality.
Good afternoon, and thank you for the opportunity. If I may go back
so I don't want to backfit.
Quantitative tightening, just to understand whether there is more ground to cover on QT, or whether with this end of reinvestments on APP, this is the end of QT. There could be more to be done with PEP, for example, starting on pandemic, or selling bonds to make it even quicker. So this also helps to understand how important is QT.
I just love all these different European accents. Love
My
it.
second question, if I may, is on TLTROs, because even if the European banking system is solid and resilient, and the banking crisis from the US could be over,
will they have blueberry pancakes?
In an odd moment. And are you concerned, or are you confident the banks can give back 500 billion in June and get away with it? 407 about, yeah. Thank you.
Thank you very much. On QT, let me be very clear. QT is the decision that we expect to implement as of the 1st of July concerns APP reinvestment only and nothing else.
Yes, true. That's true, Bernd.
We have forward guidance on PEP reimbursement, nothing until 24.
But it's not necessarily trying to predict.
You will find, I think, in the
it's trying to explain
to my statement reference to the PEP and to the principle of flexibility, which we believe is an important.
That's why there's a 5-year and a 20-year
PEP going forward. So those tools are intact. We're not planning on not reinvesting anything that comes for redemption under the PEP agreement. On the on TLTRO, well, TLTRO, there is no surprise about TLTRO. If anything, we have managed to offer the possibility for banks to accelerate and anticipate the reimbursement, which I think has avoided a cliff effect that we would have had in the over $1 trillion would have become outstanding in June. Thanks to the accelerated reimbursement, we're now down to 477. I'm checking the numbers because I want to be clear on that. So it's not a surprise. It's a come due date, and reimbursements are due, and I know that banks have prepared for it, and that there is a lot of liquidity out there to continue to prepare. Having said that, it wouldn't surprise me if some of the facilities that we have, that are standing facilities, liquidity windows that are available, full allotment and rates that are well known to all, would become usable. They are usable, but would be used again, because that's perfectly normal job of a central bank to actually provide liquidity. We have weekly, we have the LTRO, 3 months, full allotment on all those liquidity facilities. And if anything was to happen, we have demonstrated in the past that we can be inventive. Thank you.
Thank you very much. This concludes our press conference today. So I wish you all the best. We have
Okay.
the next press conference
They're going to
on
go
15th of
smoke
June.
cigarettes and drink
until
some red
then, all the
wine.
best and a good afternoon. Thank you.
So I guess we'll leave them to it. Thank you for hanging with me today. It was real. If you're in my swing trading group or day trading group, we will be meeting at 4 p.m. to plan next week. So please visit fxbootcamp.com for more information. Peace on earth. May the pips be with you. May your profits be above average. Thank you for being a member of our community. Click the thumbs up button on the way out. And I'll see you when I see you. Remember, tomorrow
Good
is...
afternoon, everyone. My name is Mario Cogliaguer. I'm the Director of Supervisory Strategy and Risk at the ECB.
I don't know where this is coming
It
from.
is a
hang
pleasure
on.
to open this conference and to welcome you at this.
There we go. So, yeah, remember tomorrow's Trade Non-Farm Payrolls Live, $1 billion. I'm not sure which one it is, but I'll be over at FX Street tomorrow. So maybe check out their YouTube handle, youtube.com/FX Street. So, peace on earth. May the pips be with you. May your profits be above average.